Hi, this is Paula with the Paula Martin Group here at Keller Williams, and I'm here today with Rich Berry from Pride Rock Mortgage, and we're going to just do a little dip our toes in financing. And today we're going to talk about FHA. So Rich, when we meet a new client and we're getting started with that buyer, and we say, hey, you got to, we want to get you to a banker. We need to figure out what the best program is for you. And of course, there's different options, and certain people are going to fall into several groups, and some are going to really align well with one particular program. So with FHA, who's that person? What does that buyer look like?
Well, typically FHA would be maybe someone who has a little weaker credit score. You can actually do an FHA loan down to a 580 credit score if you wanted to, but it's someone who has a little bit weaker. They didn't quite qualify for, say, a conventional Fannie Mae, Freddie Mac type loan, which takes a little bit higher credit score typically. They would have, say, they could also have a higher debt to income ratio. On an FHA loan, you can go to 56.9% debt to income ratio, which I can explain in a second. Also, you can put down relatively little money. You could put down 3.5% on an FHA loan. So it's somebody, again, if maybe they don't quite make conventional guidelines, but it's a 30-year fixed. The rates are relatively low. It's a government-backed loan. It's Federal Housing Authority Administration is the FHA.
So sometimes it might be somebody that's just new, like brand new. Yeah. They don't really have credit. It's not that they don't have good credit. It's more maybe they just are getting started. Yeah. One of the things that we've done in the past is we've been able to take an FHA and do a non-occupant co-borrower. Yes. That's kind of a little different program, but you want to just talk briefly on how that might benefit somebody?
Yeah, Fannie, Freddie, FHA all offer non-occupant co-borrower programs. And that's kind of, I suppose, the housing equivalent of co-signing for a car. So in other words, let's say you're buying a house and you have the house you want, and maybe the numbers don't quite work right. They're not quite there. Then you can have, say, a parent or sibling or somebody like that can co-sign with you. So they're co-signing, and when they do that, we can use their income to help qualify the loan. So it helps quite a bit. If things are a little tight and someone's just starting out, and a sibling or somebody helps them out, and then 6 or 7 or 8 months or whenever down the road, when their situation changes, improves or something, then we can just refinance them and take that person off.
I've definitely seen that be helpful. One of the other things that we noticed is sometimes it just depends on where somebody is in their life, right? Like they may actually have a lot of cash to put down, but they don't necessarily, their debt to income ratio is still a little tighter. So they don't necessarily have to put 3.5. We've had people put 25% down, but they were able to take advantage of that forgiving credit score and then the expanded debt to income ratio. Yeah. So one of the things that FHA does want to just know that the house has safety, structure, and systems. So they are going to take a little deeper dive into making sure that those things are acceptable. And in most cases, if something's identified,
if something comes up, most anything can be addressed. Sometimes, let's say you send the appraiser out there and they come back and they mention something on the appraisal like chipping paint or something like that, then that can usually be worked out between buyer and seller. It's usually not that big a deal.
Yeah, and then of course, your agent can also right up front, if that's something that they identify, address it right up front when you're making your offer. But one way or another, there is a little bit more of a stipulation. They're a little more stringent than conventional, but certainly, as a team, we all work ourselves through it. Is there anything else you think with FHA that's helpful for a buyer to know right now?
Just that FHA is very, very forgiving on credit score. It's very forgiving on debt to income ratio and allows for very small down payments. So some people will say, I just don't have the down payment. FHA is set up for that. They self-insure, so every FHA loan has PMI, or it's called MI or MIP on a government loan. But anyways, they all have that, and the reason they have that is they'll allow for the weaker credit scores, they'll allow for the low down payments, and they'll allow for the high debt to income ratio. So it's a very forgiving program in that regard. It also comes in handy if people say have student loans or debts like that they're not really willing to pay off, and it kind of increases their debt to income ratio. Then they can go with an FHA loan and not have to worry about paying those off.
Can you get rid of that?
What's that?
The
PMI, yes.
Yeah.
If you put down 10% or more on an FHA loan, then you will lose PMI in 11 years. Or you can refinance when, say, the market is favorable or your situation changes. You can refinance off the FHA loan onto, say, a conventional loan.
So you can get rid of that and use it as like a segue to get in.
Absolutely. It's a
Nice.
perfect way to get in the house. It's a lot of first-time home buyers use that. That's a very good program. So
Yeah, and I've actually seen very established people use it as well, just because it's
Absolutely.
favorable for using other people's money.
Yeah.
Which, you know, sometimes is the way to go. Well, thanks for coming over. Thanks for talking to us today. If you have some questions about financing, comment below. Rich Berry, PrideRockMortgage.com, and then Paula Martin Group, PaulaMartinGroup.com. We're glad you took a few minutes to look at our video, and we'll talk soon.